Hey everyone, Logan Hertz here with Hazeltine LLC. We are back for part two of our interview with Sebastien Boyer, the approved guy. Sebastian, how you doing?
Excellent. Thank you, Logan. How are you?
Doing well, doing well. So we covered infinite banking and velocity banking in part one of the interview, in addition to getting some of Sebastian's backstory, what he's passionate about, why he does what he does. And now we want to get into a topic that I'm starting to cover more on my channel. I know Sebastian is too, is how do we combine the two? Because a lot of my clients, and I know a lot of Sebastian's clients, are doing both, right? They have maybe a first lien HELOC on their primary residence where they're doing velocity banking, and then they also have whole life insurance policies that they're doing infinite banking with. And I have to emphasize velocity banking does not equal HELOC. Infinite banking does not equal whole life insurance, right? There's a strategy, and then there's the vehicle that we're using.
Right.
But when we combine the two, I think there we can get exponentially more. It's not a 1 + 1 = 2 scenario. It's a 1 + 1 = 8 or 10 scenario when we combine these two. So Sebastian has coined the phrase infinite velocity. So Sebastian, you want to tell us a little more about infinite velocity?
Definitely. So, first of all, thank you again for having me on the channel again. And, I want to say thanks to your audience. And basically, what we're doing is we're marrying two separate systems, two separate strategies into one strategy. Um, with velocity banking, just to kind of recap and simplify, we're using a line of credit to speed up the process of paying off debts because of the feature of the line of credit with revolving in it, money can come in and out, simple interest, and the your income and cash flow helps to reduce the balance of the line of credit. Therefore, the effective interest rate you pay on the line of credit is lower, and that frees up more cash flow, so you can reallocate more cash flow to pay off more debt. This is what speeds up the process and effectively allows you to pay less interest. This is using a line of credit, a home equity line of credit. It could be a first position or a second position HELOC. It could also be a personal line of credit, a business line of credit, and you can even use credit cards as a part of the process, especially to pay for living expenses, but not so much for paying off mortgages or bigger debts. Um, so that's velocity banking. Now, infinite banking again is a system or strategy where we are creating our own banking system. If it's personal, it's your lifestyle banking system. If it's business, it's your business banking system. And what you're really trying to do is you're trying to recapitalize on the expenses and the debts that you would be normally paying interest to the banks on by creating your banking system, paying yourself first, paying yourself with interest, and then recapitalizing your bank by starting with your own bank. You are able then to recapitalize on those expenses and debts, thereby turning your liabilities into assets. It's that simple. Now, the process of putting infinite banking in front of or next to your velocity banking is not going to speed up how fast you eliminate debt. So if your number one focus and goal is I want to get out of debt, I don't want to do anything else, then putting your infinite banking is not going to speed up the process. What it's going to do, it's going to have like a tailwind effect. Think of it like a rubber band or a slingshot, because you're going to kind of slow down a little bit, but then it's going to launch you forward in the long run. So there's two things that I always show my clients when we're looking at should you or should you not put an infinite banking system or strategy in front of your velocity banking, your debt elimination. One is your insurability, because there's no guarantee if it takes you 5 years or 10 years to pay off all your debt that you're going to be insurable in 5 or 10 years. There's no guarantee you're going to be insurable in a week or a month from now, right? So
In
you
other
want to
words, your
lock
health
in
your health might decline,
your
and
health
then
might
you
decline.
might not be eligible for life insurance.
Correct.
So yeah.
So there's urgency to
Now,
secure.
no one believes me, Sebastian. No one believes me when I tell them that your health can decline. They don't
Listen, you
believe me.
might stay healthy, but you could slip on a banana peel. I mean, honestly, I
And it
slipped
might
on
be
my
a family
steroid the other
member.
day.
It might
Huh?
not even be you. Your
Right.
the health of your family members absolutely comes up in underwriting.
That's right. So, anything can happen. We are not guaranteed tomorrow. We're not guaranteed our health. And obviously we all want to hope and assume we're going to remain healthy, but that is not something you can guarantee. And even if you remain healthy, 5 years from now, 10 years from now, you have aged. Therefore, the cost of insurance has increased. And
Mhm.
so therefore, if you're really trying to design a policy to get the max cash value for your banking system, right? And just to reiterate what that is, inside of the life insurance policy, we have two parts to it. We have the cost of insurance, which is purchasing the insurance. It's paying for the death benefit and the insurance policy. That is your payment for the insurance. The rest of your money, which could be anywhere between 90 to 60% of what you're putting into the policy, don't think of it as a payment towards insurance. It's not. It's more of a deposit that you're putting into your savings account that we're calling your invisible vault or your saving space. Insurance companies call it your paid up additions, which is where the cash sits. This cash vault that sits inside the policy is not insurance. That is not life insurance. That's literally a saving space that's going to grow with guarantees, typically between 3 to 4% on guaranteed compounding interest, plus dividends between 5 to 6%. And so this is
And it's
the
all
only
tax
place.
free. So that's 5 to 6% tax free, which is based on the current dividend rate, which is low.
Correct. Correct.
And I do have to nuance something that Sebastian said. Um, so paid up additions doesn't necessarily equal cash value. That base premium also grows your cash value as well. It just doesn't grow it right at the beginning, right? Paid up additions kind of gives you a shot in the arm of cash value, but over time, that base premium grows your cash value too, and it grows it quite a bit, especially in the later
Yeah.
years.
It does contribute to it. But when we're looking at, getting a lump sum of cash value access immediately
Mhm.
within the first 30 days of
Right.
putting our money into the policy, because we want to start using it as our banking system, that's where we're going to be putting the money to be able to really leverage it immediately. And again, you don't have to wait a year, 4 years, or 5 years. You can literally set up a policy, put your money in, and get it out to leverage into your business, into your lifestyle, into your debt strategy within 30 days. And again, that's going to be between 90 to 60%, 60 to 90% of the total premium that you put into the policy can be allocated to that cash value bucket. Okay. So the reason I want to emphasize that is because when we talk about life insurance and we say, okay, we're going to put 100,000 in to a policy, a lot of folks just immediately think, well, why would I put $100,000 towards a life insurance policy? But if you separate that and you realize, okay, of that 100,000, perhaps 20,000 is paying for the cost of insurance, the death benefit. So you are purchasing a life insurance policy, and 80,000 hypothetically is going into that cash value, into the savings bucket. And that's the amount that you can leverage. You can access that within 30 days. You can borrow against that up to 90% of that amount, what's in that cash value bucket. So now you're able to leverage that and put that into your velocity banking strategy. You can then put that into the HELOC. And now the same money that you would have been putting into the HELOC before, where it was only doing one thing, which is contributing to your velocity banking, now that money's doing two things, more than two things really, but primarily it's gaining guaranteed compound interest plus dividends, tax-free growth, uninterrupted, by the way. So that means that while that money's sitting in that HELOC, while that money's being used to pay off debt or to invest in your business, however you're going to use it, it's also going to continue growing uninterrupted compound interest and dividends. And that's tax-free, uninterrupted growth that you have inside the policy. And that's what makes this such a powerful tool as part of your banking system, because that there's no other instrument that you can put your money in, get it out, and continue to realize growth on that money at the same time while you're using it on the outside of that instrument. There's none of, plus that tax-free growth. There's nothing else that gives you that functionality. So that's why we use the whole life with a dividend participating, dividend paying mutual company, that's why it's so important. And we have that max cash value, we can access it, we can leverage it, and then it's all protected by the death benefit. So in the end of your life, if you haven't fully paid back your policy loans, then it gets settled by the death benefit. What that does for you is it gives you flexibility in terms of how fast you pay it back to your policy. So in the meantime, you may have debts that you're trying to pay off with your velocity banking strategy, with interest rates between 8 to 27%. Your policy loan average is somewhere between 5 to 6% is the average policy loan right now. So if you're gaining guaranteed compound interest growth at around 5 to 6%, the one thing I always advise is don't let the compound interest that's being charged on the policy loan, don't let that compound against you. And you can stop the compounding against you by simply paying the interest at the end of each year.
Right. It is. So we're getting into a bit of inside baseball, but when you borrow against your policy, it is technically simple interest,
Correct.
but there's no such thing as infinite simple interest. Simple interest always eventually expires. So in this case, you are being charged simple interest for a year.
Right.
So if you pay that interest within a year, you prevent that interest from compounding against you.
Correct.
But that interest can be accrued indefinitely because there are no repayment terms on a policy loan.
Correct.
Because as Sebastian says, the death benefit will pay off that loan if you don't pay it off while you're alive.
Exactly.
It's depending on the use case. There are reasons why you might not want to make any payments. There can be. But generally speaking, it's better to strategically pay back policy loans on a schedule that makes sense for you. So you are now your own banker. You are in charge.
Right.
That loan, you decide what the repayment terms are. So no one is going to come to repossess your house if you don't make payments. If you want to pause payments for a time, you can do it. It's totally up to you. And when you pay it back, you're just recapitalizing your own banking system, right?
Exactly.
That's money you can pull back out again. It's a two-way street, right? Whereas if I pay off a personal loan to some lender, when I pay it back, that money's gone, right? I
It's
don't, I
gone.
don't, I don't get that money back,
Can't get it back.
right? Right. So, and I think one of the great things about the complementarity between these two strategies is when you think about velocity banking for a second, let's imagine you have a house, okay, and you have a mortgage and you have, let's say you have $200,000 of equity in your house, okay? When you replace your mortgage with a first lien HELOC, you immediately get access to 90% of that equity, right? So you have immediate liquidity, right? That's one of the benefits of that particular use case. Versus one of the drawbacks to infinite banking is, at least initially, you have to give up some liquidity. If I dump $100,000 into my policy year one, I'm not going to have access to $100,000, right? There is a cost involved. Some of that money has to go to the insurance company. Now, eventually, you will have full liquidity, and how long just depends on how the policy is structured. So what it can do is there can be a great complement now where on net, you personally actually don't give up any liquidity, because the liquidity you give up when you take out your whole life insurance policy is more than replaced by the liquidity you freed up when you took out your first lien HELOC, right,
Correct.
Sebastian?
That's correct and true. And even, I don't like to think of giving up liquidity when you're setting up your policy, because if that money was the just being put in an account where you just couldn't access it or touch it, if it wasn't doing anything, but there is a designation of that cost, that premium, it is purchasing a life insurance policy, which does have a death benefit, which ultimately is what protects all of this, and which gives you living benefits that you can access while you're alive, and ultimately becomes your legacy and your generational play, right? And protects your loan. It gives you a hedge. That's what creates a hedge against losses if you're unable to pay back that loan, because it gets settled by the death benefit. So, I think there's a value there that should really be emphasized, and we are purchasing something. We're not just purchasing a savings account. We're purchasing a very valuable asset in a life insurance product, which also opens up our ability to save, store, and access our cash while it's growing compound interest with dividends tax free. So for me, that's a, even though, yes, I am giving up liquidity, I'm not just giving up liquidity for nothing. There is an
Right.
exchange, there is a value for that portion that I'm giving up, to be able to gain access to my banking system. And obviously, in the early years, you see that, but in most cases, your policy will outperform your insurance cost within 5 to 10 years. So within 5 to 10 years, you'll see that the compounding interest and dividends has grown to surpass what you have paid in the cost of the insurance. And once you've hit that mark, once you break even on that, then it's just growth from there. From that point, it becomes a 100% profitable policy in terms of performance and growth. And again, it's going to continue to grow and compound. So now when we're looking at 15 years from now, 20 years from now, 30 years from now, that's where it becomes amazing, right? Because the power of compound interest over time is a beautiful thing. And many people underestimate the power and the value of that compounding interest, because they're only looking at short-term gains versus the long-term performance that you can't replace with almost any investment in terms of the long-term performance. And the thing that's beautiful about this is that, right now, maybe for the first 5 or 10 years, you're going to be using your infinite banking policy strategy, your banking system, alongside your velocity banking or your debt elimination strategy. But eventually, you're going to pay off that debt. Eventually, you're going to get to where you have no more debt, and you're going to perhaps focus on recapitalizing your policy. And at that point, you have a cash rich policy. And now what can you do with that? Now you can change your use. And that's what's beautiful is that, as you grow, your policy grows in value. And as you grow in age, your need and your use for the policy is also going to be changed. And you can use it for an entirely different purpose. So now you've paid off debt. Now you can start using it for investment purposes. Or maybe you're going to use it for your kid's college or for your kid's wedding or for anything you want that you're going to be spending money on. Maybe you're going to buy your next car with it instead of financing it through, the car financing. You finance it through your own banking system. Ultimately, in your retirement years, now you have a supplement to your retirement plan that you can use for your retirement. So as you grow, it's going to grow, and your use of that policy, of that cash value, is going to change, and it's going to change with you. And again, ultimately, at the end of your life, the death benefit is always greater than the cash value, which gets left behind to your next generation, in your legacy play.
Yeah, I really liked that analogy you used of the rubber band, where when you introduce infinite banking, you do take a step back in terms of paying off your debts because now you have to redirect cash flow to that policy. But in
Right.
the long run, you end up much further ahead. And I'll
Correct.
include a link in the description below where I went through a use case showing, you know, um, if you pay off your debt faster, you pay less in interest. And people see that. People see that. And I show a scenario where, but if you delay taking out your whole life policy by, in this example, 3 years, it costs you more than 500,000 in retirement income, right? So in that example, I think you paid like $50,000 less in interest because you paid
Right.
off your mortgage and everything a lot faster, right?
Right.
And so people see that, and so they're like, yeah, that's good. It's like, yeah, but what you didn't see was the $500,000 in retirement income that you gave up because
Gave
you
up.
delayed starting your whole life policy by 3 years. So would you rather eliminate $50,000 of interest costs or lose a $500,000 of tax-free
Yep.
retirement income?
Yep. And that
Right.
and that is the second reason we should seriously consider implementing our banking system sooner than later. The first being your insurability, and there's no guarantee that you can qualify for insurance. And the second being is the opportunity cost. It's the lost opportunity of growth and compounding interest. The longer you wait is the less time that your money has to compound and grow. And as Logan just said, that could be the difference between saving $50,000 in interest on paying off your debt or gaining 500,000 in compound interest inside your policy in your later years in retirement. And that's a huge difference. So I think it's what I try to do, Logan, is when I show a client this, I'll show them an illustration of a policy starting now, and I'll create the same policy, but starting 5 years from now, and then starting 10 years from now. And then when you see that, I mean, at that point, it's a no-brainer, because why would you give up 500,000 just to save 50?
Right, right. Even waiting 1 year, because
Even when,
keep in mind this, when you wait 1 year, you're eliminating the best year of the policy, because the best year of the policy is the last year it's in force. The number one most important element with infinite banking is the passage of time. That's why it's so important to start it earlier. Now, there can be psychological reasons why some people just hate debt and they want to get
sure,
out of it. And that's totally fine. I just want people to understand the trade-offs that you're making.
sure,
If you would rather just be out of debt, there's no problem with, I would say, take out a convertible term life insurance policy so you
100%.
protect your insurability, you
Right,
have the death benefit protection that you need. But if you want to wait 3 to 5 years to start your infinite banking system because you want to pay off all your debts first, as long as you understand the trade-offs you're making,
right.
that's fine.
That's
But
fine.
the things that are unseen are what we don't manage very well. And I think a lot of what Sebastian and I do is try to help people see what is unseen. The
Right,
opportunity cost is so huge and you can't see it. Whereas the interest people pay, they see that and it causes them pain. So they tend to manage it pretty well because they can see it, right? What they can't see is the opportunity cost, right? And
right.
that's where we have to help people to see that so they make the right financial decisions, right? Based on everything, not just what they can see in front of them and not just
Exactly.
based on numbers, right?
Exactly. And so that's why, yeah, again, I think it's important to show the client all of their options and then let them decide. And again, if you as a client, if you're looking at it and still emotionally, psychologically, you feel like you want to just focus on paying off the debt and come back to the strategy of your banking system later on, then as Logan said, at least secure a convertible term policy which locks in your insurability, so you know that you can qualify. You don't have to take a test and qualify later. You're basically grandfathered in, and based on that death benefit, you can roll it over into a new whole life during that term, and then start your banking system later. So minimum,
Right.
I would recommend at least do that. So I always show that as well. I'll include it my group of illustrations, a convertible term, just so you know, hey, worst case, you can start here. So
Yep.
you lock in
Yep.
that insurability.
Yep. So if it takes you an extra 3 to 5 years to pay off debt, it's not going to ruin you. It's not a massive deal. If you wait 3 to 5 years to start your infinite banking system, there's a large unseen
Yeah,
opportunity cost. So I want to pivot to another subject. Before I do
sure.
that, Sebastian, you just want to close us off on what is infinite velocity and why should people do it?
Yeah, so infinite velocity is literally creating your own lifestyle or business banking system, using a tool that is going to give you guaranteed compound interest growth with dividends, at a rate of between guaranteed between 3 to 4%, with dividends between 5 to 6%, tax-free growth. Your banking system is going to grow uninterrupted as you're using the money at the same time through policy loans, where you can use that to put into your debt elimination strategy, whether you're doing debt snowballing or you're doing velocity banking with a home equity line of credit or some type of line of credit, which helps to speed up the process of paying off your debt. You're able to leverage the cash flow that's in your policy through the policy loan to feed into your velocity banking, into your line of credit, to help speed up and pay off and eliminate your debts. And at the end, when you finish paying off the debts, instead of having a zero balance, you have a policy that you can recapitalize and recapture the expenses and the debts in your policy, thereby growing your banking system, which you can leverage again and again for the rest of your life. So I hope that sums it up nice and neat.
Excellent. Excellent. Yeah, there's a lot more we'll talk about this because there's so many use cases we can explore. It just opens up so many possibilities because you have these two strategic pools of liquidity now, one in your house, one in your whole life insurance policies, and there's just so much you can do with it.